A 62-year-old man named David walked into his bank 3 years ago, nervous about retirement, looking for someone to tell him his money would be safe. The advisor had a solution ready instantly: an annuity. Guaranteed income for life, he said. You'll never run out of money, it's the safest option. David signed the paperwork that same day. $200,000 locked into that annuity, with promises of lifelong security ringing in his ears. What David didn't know is exactly how much that safety was going to cost him: real money quietly disappearing into fees and restrictions. Today I'll walk you through what an annuity really is, why banks push them hard, and the honest math versus a simple index fund. Let's start with basics. Most people who own an annuity couldn't fully explain what it actually is if you genuinely asked them directly. An annuity is a contract between you and an insurance company. You hand them a lump sum, and they promise income in return. Sometimes starting immediately, sometimes later, sometimes for a fixed number of years, and sometimes guaranteed for the rest of your entire life. On the surface, that sounds exactly like what a nervous retiree wants: guaranteed income, no market risk, a paycheck that never stops. That promise is technically real. The company will keep paying as agreed, but what that guarantee actually costs rarely gets fully explained. Let's talk fees, because this is where annuities, particularly complex ones, get genuinely expensive for the person actually holding the contract. Many annuities carry a mortality and expense fee, often between 1 and 1.5% annually, charged every single year. On top of that, additional rider fees for optional features can add another 0.5% to 1.5% more. Stack those together, and combined annual fees often land somewhere between 2 and 3%, sometimes higher with added riders included. Compare that to a total market index fund, commonly charging around 0.03 to 0.10% yearly. That's not a typo at all. We're talking a fee difference that can be 20, 30, even 50 times higher for the annuity compared to the simple index fund. This isn't a one-time cost, it's charged every year, on your entire balance, whether the annuity's investments go up or down. Over 10, 15, 20 years of retirement, that fee gap compounds into a genuinely enormous amount of lost growth over time. Here's something else rarely mentioned clearly up front: the surrender period, which can quietly trap your money for years without warning. Most annuities lock up your money for 5 to 10 years, sometimes longer, with harsh charges if you withdraw beyond a small percentage. These surrender charges can start at 7, 8, even 10% of your withdrawal, gradually declining until the surrender period finally ends. Imagine David, 3 years in, facing a medical emergency where he genuinely needs access to a large chunk of that $200,000. Pulling out more than his allowed amount could cost tens of thousands in penalties alone, money that simply vanishes on top of everything. An index fund, by comparison, is highly liquid to sell shares, access your money within days, no surrender charge, regardless of how long held. Let's run real numbers now, using David's actual $200,000 as our working example throughout this entire comparison. Say David's annuity, after all fees, effectively grows around 3 to 4% yearly, a realistic outcome once fees are subtracted properly. Over 15 years, that $200,000 might grow to roughly $320,000 to $360,000, without drawing down principal. Now imagine David instead invested in a diversified index fund, using a sustainable 4% annual withdrawal strategy for his retirement income. Assuming a conservative 7% average return, even after withdrawals, his investment could have grown to $450,000 to $500,000. That's a gap easily exceeding $100,000 over 15 years, from the exact same starting amount, the exact same retirement savings. So if the math often favors index funds, why do banks push annuities so aggressively, especially toward nervous, risk-averse retirees like David? Once again, the answer largely comes down to commissions. Annuities often pay advisors 5 to 10% of the invested amount up front. On David's $200,000 annuity, the advisor may have collected $10,000 to $20,000 in commission the moment he signed. Regardless of how the annuity actually performs for David over the following 15 years, that commission was already paid out completely. Compare that to an index fund, which typically pays no commission at all, meaning less financial incentive for anyone to recommend it. This doesn't mean every advisor selling annuities acts in bad faith, but you deserve to understand the incentive sitting across that table. Now, to be fair, annuities aren't universally bad. and there are genuinely specific situations where they can make real practical sense. For retirees deeply anxious about volatility, who know they'd panic sell during a downturn, guaranteed income can provide real psychological security worth something. For people without a pension worried about outliving savings, a simple, low-cost immediate annuity can serve as one piece of a plan. The key word is piece. Most planners suggest annuitizing only a portion covering essential expenses, keeping the rest in flexible index funds. This brings us to the actual myth worth naming, that guaranteed automatically means better for your overall retirement outcome and financial future. Guaranteed income has real value, but guarantees aren't free. You pay through high fees, reduced growth, and years of restricted access. Index funds don't guarantee anything specific yearly, some years up, some years down, but historically over full retirement horizons, growth wins. The question was never guaranteed versus risky, it's which trade-off, once fully understood, genuinely fits your situation and retirement timeline. So here's a simple framework: if volatility genuinely keeps you up at night, some guaranteed income covering essentials might be worth the cost. If you can tolerate normal market swings and understand retirement spans 15 to 30 years, index funds have historically delivered stronger flexibility. Before signing any annuity, always ask about total fees, the surrender period length, and exactly how much commission the advisor receives. Regardless of direction, always get a second opinion from a fee-only advisor who charges directly rather than earning commission from products. Now someone will say, but what about sequence of returns risk, if the market crashes right when I actually retire? That's legitimate, and it's why withdrawal strategy matters separately. Many retirees keep stable assets specifically to avoid selling during downturns. A blended approach, small guaranteed income for essentials alongside a larger flexible portfolio for growth, can address this without full annuity fees. So here's the honest truth: annuities aren't a scam, and guaranteed income has genuine value for the right person in the right situation. But guaranteed doesn't mean optimal, and locking up entire life savings without understanding true costs can quietly cost over $100,000. If you currently hold an annuity, don't panic and exit today. Surrender charges can be severe. Talk to a fee-only advisor first. But if you're approaching retirement, now you understand the real trade-offs behind that guaranteed income for life pitch you'll likely hear someday. Tell me in the comments, has anyone pitched you an annuity? What did they tell you it would actually do for you? If this helped you see the real math clearly, hit subscribe, because next week we're breaking down another retirement product that sounds safe. I'll see you in the next one. Thanks so much for watching, and take good care of your retirement savings.